red arrows, sirens on the telly, a recession looming, panic on every screen, and your finger hovering over the sell button. Stop right there, dear viewer. You're being played, and today I shall show you exactly how. By whom? Here's the uncomfortable truth. The financial news isn't designed to make you rich, it's designed to keep you watching. And the investors who react to it are selling in fear, buying in euphoria, reliably end up poorer than those who don't. Stay with me, because this isn't a conspiracy theory. It's simply incentives. The news industry earns money from attention. Markets transfer money from impatient people to patient people. Put those two machines together and you get a rather expensive trap. And the cost is real. Studies consistently show the average investor earns far less than the very funds they invest in. Same fund, same returns on paper. The gap comes from one thing: jumping in and out at the wrong moments. Those wrong moments are almost always headline moments. So by the end of this little lecture, you'll understand the three mechanisms behind the trap earns and the simple plan that makes you immune. Shall we begin? Splendid. Mechanism number 1. News exists to capture your attention, not to grow your wealth. Every outlet, television, websites, apps, Apple gets paid when you watch, click, and stay. Fear and outrage are simply the cheapest fuel for that engine. Think about it. Markets in turmoil gets clicks. Markets basically fine, carry on doesn't. So even in a perfectly ordinary year, the coverage skews dramatic, urgent, and alarming. The drama isn't a measurement of reality. It's a business model. Your brain makes it worse, I'm afraid. Humans evolved to treat threats as urgent and good news as ignorable. Psychologists call it negativity bias. Headline writers don't need to lie to you, they merely need to select what frightens you. Notice the language next time. Markets never simply fall. They plunge, plummet, crater, and bleed. A 2% dip becomes carnage. This vocabulary isn't chosen to inform your decisions. It's chosen to spike your heart rate and hold your gaze. And here's the quiet part. The people producing that coverage aren't villains. They're employees of an attention business, doing their jobs frightfully well. The mistake is yours and mine, treating an entertainment product as if it were investment advice. Mechanism number 2, and do pay attention, this one stings. By the time news reaches you, it's already priced in. Markets move within seconds of new information. Professional firms trade on it before the article is even finished being written. Picture the chain. Something happens. Algorithms react in milliseconds. Professional traders react in seconds. Prices adjust in minutes. The article gets written, edited, and published in hours. You read it that evening and decide to act. You're last in line. So when you sell because of a scary story, you're not avoiding the drop. The drop already happened. That's why the story exists. You're selling after the damage, locking in the loss, and handing your shares to someone calmer. The same applies to good news, by the way. By the time a company is being celebrated on every front page, its price already reflects the celebration. Buying, then, means paying full price for optimism everyone else purchased at a discount. In short, reacting to headlines means trading yesterday's information at today's prices. You can't win that race. The news is, by definition, what the market already knows. Which raises a darker question: who's on the other side of your trade? Mechanism number 3, the fear and greed transfer. Every trade has two sides. When panicked investors dump shares at the bottom, someone is buying them. And it's rather rarely another panicked beginner. It's typically patient, professional money. There's an old market adage: the time to buy is when there's blood in the streets. Grim, I grant you. But it describes how markets mechanically work. Fear creates discounts, and disciplined buyers collect those discounts from frightened sellers. Then the cycle reverses. When euphoric headlines declare a new golden age, those same disciplined players quietly sell their cheap shares back out, at top prices, to the excited crowd rushing in. Fear shakes shares loose. Greed hands them back. Now, nobody needs to plan this in a smoky back room. It's not a conspiracy, Tess, it's a conveyor belt. Dramatic coverage produces emotional trades, and emotional trades reliably move money from reactive hands to patient ones. The machine runs itself. And what of the television experts, forecasting doom or riches with such marvellous confidence? And therein lies the trick. Nobody tallies their misses. A bold prediction earns airtime whether it's right or spectacularly wrong. There's no refund desk for bad forecasts. Some famous pundits' stock picks have been studied and found to underperform a plain, boring index fund. Their actual job is compelling television, and they're terribly good at it. Forecasting markets, alas, is nobody's job because nobody can do it reliably. Don't take my word for it, dear viewer. Let's examine the receipts. March 2020. COVID crashes global markets roughly 30% in a month. The headlines at the very bottom were apocalyptic. Depression, collapse, the end of the bull market forever. Anyone who sold on those headlines sold at nearly the exact bottom. The market then staged one of the fastest recoveries in history, hitting new highs within months. The scariest coverage appeared precisely when buying was about to pay off most. It works in reverse too. Near major market tops, you'll find giddy headlines predicting the index will triple, books proclaiming a permanent boom, and everyone's neighbour suddenly a genius investor. Peak euphoria in print has marked many a peak in price. Or recall the meme stock frenzies. Wall-to-wall coverage arrived after prices had already multiplied. The crowds who piled in on those stories mostly bought near the top and the studies of that episode show exactly who ended up holding the losses. And the grand total? Studies of investor behaviour consistently find the same ghastly gap. Year after year, funds earn one return, while their investors earn meaningfully less, purely from buying high and selling low at emotional, headline-driven moments. Right then, enough Dumas, let's talk defense. How does one actually become immune to all this? Not by being smarter than the market, and certainly not by reading more news. You become immune with a plan. 5 steps. Step 1. Write your plan before the panic. Decide in advance what you own, why you own it, and what would genuinely make you sell. A decision made calmly on paper beats any decision made at midnight with a racing pulse. Step 2. Automate your investing. A standing monthly transfer into broad, diversified funds buys through good headlines and bad ones alike. Automation removes the very thing the news machine feeds on, assess quote, your in-the-moment emotional judgment. Step 3. Lengthen your horizon. Headlines live for a day. Your money should be invested for decades. Over any single-year markets are a coin flip, but over 20-year stretches, broad markets have historically rewarded patience handsomely. Zoom out, always. Step 4. Rebalance on a schedule, not on a story. Once or twice a year, on a date you've chosen, nudge your portfolio back to its targets. That forces you to trim what's run up and buy what's fallen. Automatically sensible. Step 5. Put yourself on a news diet. Check markets monthly, perhaps quarterly. I assure you, your portfolio doesn't grow faster when watched. If anything dreadful truly requires your attention, your written plan already says what to do about it. And a bonus trick for the advanced student, use dramatic headlines as a contrarian smell test. When coverage turns apocalyptic, history suggests bargains are forming. When coverage turns euphoric, caution is warranted. Not a trading signal, a sanity check. One small permission slip before we finish. You're allowed to ignore the news, truly. Skipping the daily market drama isn't irresponsible, Owacy. It's the discipline that separates wealthy investors from busy ones. Boring, consistent, automatic. That's the whole secret. Shall we recap then? Splendid. 1. News is an attention business, Al. Fear sells, so coverage skews scary regardless of reality. 2. By the time you've read it, it's priced in. You'd be trading on stale information. 3. Emotional trades transfer money from reactive investors to patient ones. Fear shakes shares loose at the lows. Euphoria hands them back at the highs. The fix, a written plan, automation, long horizons, scheduled rebalancing, and a strict news diet. Do remember, this is education, not financial advice, the figures. I've mentioned our historical examples, and your circumstances are your own. But the principle is timeless. The calmer party to a trade tends to leave with the money. So the next time a headline screams at you to do something with your money, smile politely, pour yourself a cup of tea, and consult your plan instead. The market rewards composure. The news merely rents your panic by the minute. Now then, a question for the comments. What's the worst headline-driven money decision you've made? Confess, Nengwen, we shan't judge. If this lecture earned its keep, do like the video, subscribe for more splendid explanations, and share it with a panicky friend.